Hello, it's Patigam. The best investment book is the last book you wrote in your life. Prior to the book review, the best investment books are discussing the period of inflation in depth, so it would be very helpful if you pay attention to it as much as you can get help from the present facing inflation. As you said that it is a book that is a supplementary explanation for the existing great company, conservative investors who are ahead of the time to write are comfortable. I will start reviewing the best investment books before the book. The book describes chemical companies and electronics companies in the 1950s, and your son Ken Fisher supplemented the explanation that the chemical companies introduced in the book are now electronic companies and the electronic companies introduced in the book are now bio companies. Therefore, to help you understand, I will intentionally change the chemical company to an electronic company, and I will change the electronic company to a bio company. Invest in a great company. The book summarizes the philosophies that you believe will make the best return at the lowest risk, as well as how to invest in stocks to make high returns and continue to keep it going. Invest in great companies. In the book, we discussed how to identify companies with rare but excellent management, when to buy stocks of excellent companies, and when to sell stocks that are very rare. Investors should not rush into the market at any point in the boom when overall stock prices are high, because they are swept away by worries that inflation may lower the value of their current cash. This means that inflation should be considered as an important factor when investing from a long-term perspective. In other words, there is no reason to consider stocks that do not have the ability to raise their value by 20 to 30% on their own every 10 years as an investment destination. Of course, cash, bonds, and some stocks are essentially incapable of defending inflation, but that alone does not mean that we should throw away these assets and insist only on stock investments that will protect investors from inflation as early as possible. Each year, the real value of cash falls at most 2 to 3%, roughly equivalent to the after-tax interest income of cash. Therefore, ignoring the element of interest, the real decline in cash over 4 years does not exceed 8 to 12%. Smart investors should look at inflation from an appropriate point of view and make long-term investments that cannot guarantee profits enough to offset further depreciation of the currency's value inevitably in the future. However, it should also be noted that in short-term investments, choosing the right investment stocks and buying them at the right time is much more important than hastily preparing measures to defend inflation. However, if prices suddenly start to rise sharply and monetary managers seem to encourage interest rate hikes, the story will be somewhat different. In other words, investors should move much more carefully. The economy will naturally fall, and even if it does not, bond prices can rise and stock prices can fall due to the factor of bond yield. However, if the financial tightening continues for a while, the overall picture will be completely different. The central bank's tightening policy of high interest rates to curb runaway prices is no different from the fact that a person infected with a dangerous virus decided not to eat any nutrients, saying he would starve the virus. But just as he will starve to death before the virus, the Fed will eventually abandon its initial determination and overturn it when its pain reaches unbearable levels with its virus starvation policy. As an individual investor, there is no clear way to determine exactly when the policy will change. However, the longer the virus starvation policy continues, the more government deficits snowball, and the worse the pain in the capital goods and construction industries, the more likely it is to turn sharply and another inflation frenzy. Therefore, as the deficit budget period increases, individual investors should more carefully analyze whether the stocks they intend to invest in are suitable stocks for long-term holding. During inflation, asset values may or may not rise. However, just because the asset value changes, the stock price cannot be guaranteed to rise in proportion. The asset value itself has no power to drive a rise in stock prices. The rise in stock value is caused by two closely related factors. One is the earnings power of the stock. The second, more important factor is the consensus of the investment community on the future direction of earnings power. The reason why the two factors are closely related is that if a company's earnings per share have increased at a high rate every year, the financial community has a strong tendency to conclude that the company's high growth rate will continue for a while in the future. And this reasoning is generally correct. The growth rate of earnings per share can be added or reduced due to the temporary impact of the economic cycle, and sometimes the financial world's calculations are wrong. In any case, if earnings per share steadily rise and the share price earnings ratio continues to rise as the financial sector rates the stock higher, the value of the stock rises significantly, as is common for growth stocks. The combination of net income and share earnings ratios gives investors the highest margin when the economy is stable, and also provides the best inflation defense when the currency depreciates. In other words, stocks whose stock prices rise significantly regardless of the pace of inflation are the only stocks that can safely protect investors' assets from inflation. This is not because there is an inherently deep relationship between stocks and inflation defenses. In fact, there is no inherent relationship between the two. Nevertheless, the reason why these stocks defend inflation well is that the company's business performance is very good. All stocks fall sharply because it is normal for the entire market to experience confusion and falter in the recession, but really good stocks rebound quickly and move toward a new high. Finding and buying the right stocks is very important, and the decline in real value occurs very gradually, so you have to wait for years to find the right stocks when necessary. The price of stocks with excellent intrinsic investment value is firmly supported by a strong and high pillar of institutional demand. There is no particular risk at all here. The best companies will maintain a high share price earnings ratio, and share prices will continue to rise in proportion to net profit growth unless they lose their superior characteristics. However, if the blue chip characteristics that settled them on the pillars are eliminated, there is a really dangerous situation. This is because stock prices will fall at a much faster rate than that, not in proportion to the decline in net profit. As soon as institutions start selling in earnest, these blue chip companies lose their high premiums or share price earnings ratios that they have enjoyed so far. In most cases, however, blue chip companies' stock prices do not begin to fall until a long time after losing their past investment appeal. One reason for this time difference is that it takes time for investors to understand that there has been a change in the characteristics of the stock's distinct investment appeal. Why should individual investors continue to hold stocks favored by institutions? Shares of these stocks will rise only in proportion to their net profit gains after rising to or near a high point due to institutional recognition. Then, wouldn't it be better for individual investors to sell these stocks? Then reinvest the profits in other stocks, but if you choose and invest well in other stocks just before institutional recognition, your assets will increase at a rapid pace. The stock price earnings ratio will also rise as the stock's net profit per share rises and institutional recognition increases. In this case, the stock price will rise so fast that if the stock price rises only at the rate at which net profit per share increases, it will rise so fast that it cannot be compared. In fact, this investment method is not wrong. However, investors who invest only in this way do not understand the true characteristics of institutional stocks at all. If a stock has been recognized by institutions and stock prices are now formed at a much higher share price earnings ratio than before, this is because the future profit outlook is very clear given similar risks. My theory is that if an investor who has successfully invested and achieved a lot of value growth, some of the profits he earns should come from the safest blue chip stocks. Especially for investors who have already made significant profits, the situation in which the value of existing stocks rises further may be as desirable as the situation in which the market value is expected to rise rapidly, but the risk is also high. Stocks that have gained the status of blue chip stocks will fall very slowly even if they fall from the high rise column, so deceptive investors can detect warning signals early enough. I would like to add that the dramatic result is to move companies ahead of a big event called institutional recognition, but the problem is that it is virtually impossible to get the timing right, as the investment masters consistently say. And in order to get institutional recognition, there is a high probability of major changes such as changes in the company's business model, but the high volatility is often small cap stocks, and the smaller stocks have fewer sales sources, so the risk is higher than blue chip stocks. The teacher seems to have emphasized that blue chip stocks are relatively less likely to receive institutional recognition, but even if variables occur in the opposite salary, blue chip stocks are slowly reflected, so investors have time to think. I feel the same way. For example, large-scale stocks such as Samsung Electronics are represented by ships. It takes a long time to change the direction, and that much time is given to make judgments. Conversely, in the case of small-cap stocks, they often hit the lower limit due to rapid volatility, so investors do not have much time to make judgments. Due to this problem with small stocks, Ralph Wenger emphasized small and medium-sized companies with strong financial statements. Therefore, it seems better to have a balanced portfolio than to pursue dramatic results unconditionally. Well, continue. As times go by, the impact of prospects for economic trends on investment decisions is expected to decrease. If so, are there any other factors that investors should pay close attention to, other than those that clearly revealed their impact on investment, such as management, interest rate fluctuations, and changes in legal fields such as taxes? I believe there is, and I'm only going to call this a psychological factor that acts on stock price fluctuations. Why is a stock traded at a particular price at a particular point in time? This is not because of the current, past, or future moves the stock is visible, but because investors who are currently investing in it or are considering future investments think that the stock price of the stock will be like that. If you are curious about the public's opinion of the stock at a certain point in time instead of the inherent characteristics of a stock, it is the same as wondering about the psychological factor acting on the stock. Of course, it is true that these psychological factors have only short-term influence. If the majority of financial groups are excited and offer too good an investment outlook for any company or industry as a whole, the investment public pays a price much higher than its intrinsic value for the stock for a year or two or more. Then, at some point, when the realization that the company or industry in question does not meet the high expectations comes, the illusion is broken, and the share price earnings ratio falls to near the intrinsic value. Even when it falls, the public's reaction is so extreme that for a while, the stock is traded at a price lower than the actual intrinsic value. Think of stock prices as flying balloons connected to a wide line drawn in the sky, not to the ground. At this time, the line drawn in the sky is intrinsic value. Over time, when a company's earnings power and actual outlook improve, the line moves to a higher place, and when the basic element of intrinsic value deteriorates, the position of the line also goes down. Sometimes psychological factors work to make the balloon of stock prices rise much higher than the line and fall much lower. However, even if the stock price falls or rises more than the intrinsic value due to the temporary enthusiasm of the public or groundless pessimism, the stock price does not move very far from the true value, just as balloons flying connected to the line. In other words, stock prices will return to a position with a line at any time as gravity is attracted. And to add to that, I'm going to give you a comparison of Philip Fisher's balloon metaphor, Andrei Kostelanus' dog with a leash. Wouldn't it be closer to the truth to see the two masters explain the relationship between stock prices and intrinsic value in the same way? And, in my opinion, investors cannot predict the stock price of a company, but I think the intrinsic value of a company can be estimated through financial statements and corporate studies. In this regard, I sympathize with what Sakyong said on a broadcast. You said that in order to find a destination when you look at the map, you need to know the approximate direction of the destination, but you need to know the exact starting point where you are currently standing to set the standard. In the end, it means that the destination is the stock price and the starting point is the intrinsic value, but personally, Andrei Kostelanus' metaphor of a dog with a leash touched my heart, and the metaphor of a teacher with a dead horse in the accuracy part touched my heart the most. I feel a little sorry for Dr. Philip Fisher on this point. Well, continue. The reason why evaluating the value of stocks is not easy is that it is impossible to accurately measure the intrinsic value without a single error. It is possible to roughly measure the intrinsic value of companies in the same industry, or companies with similar growth rates can be grouped together to fully grasp the fundamentals. After comparing the bound companies and evaluating important fundamental factors such as their management capabilities, growth rates, and vulnerability to economic recession, the company can conclude that its intrinsic value is $25 to $35. I think more precise measurements are difficult. For companies that grow at a high speed, it is natural that the share price-earnings ratio is highly valued, so it may be more difficult to accurately measure the intrinsic value. What matters when measuring intrinsic value is not the current growth rate, but how far into the future this abnormal growth rate will continue. The more you try to predict the intrinsic value of the distant future, the higher the probability of misjudging, so the wider the error limit, the more difficult it is to measure the true intrinsic value. When trying to measure intrinsic value in any stock, there is nothing as foolish as trying to find the value precisely below the decimal point. This is because there are so many factors related to intrinsic value. If a stock is attractive enough into the distant future and is likely to rise further in the intrinsic value drawn in the sky, and it can be bought within 25 to 30% of the assessed intrinsic value, it can be said that the stock is a great stock that can give a high return on investment. However, it is risky to buy the stock at a price several times its intrinsic value while being excessively enthusiastic. If you want wise investment, you should understand that analysis of investment psychology plays a very important role. However, on the other hand, you should not be overly obsessed with psychological analysis. When finally deciding on an investment, it should be based only on basic facts that affect the company's performance and prospects, regardless of what the investment public's current psychology is like. Under the current conditions, it is necessary to choose stocks that are sufficiently good growth companies and provide satisfactory investment returns in the long run. If you invest based on fundamentals and have patience without being swayed by public sentiment at one time, you can earn high returns. This requires formidable patience and the ability to understand fundamentals. If you are caught up in the psychology of the investment public and buy a good stock at an inappropriate timing, the resulting profit will be somewhat disappointing. In other words, it means that becoming a psychologist is much more helpful than an economist when deciding when to buy. The moment when an economist is helpful is when deciding on a second issue that is more important than this, that is, analyzing fundamentals and choosing one with higher investment value from a long-term perspective among two or more stocks. Various stock price crashes or soaring prices that appear against the overall market decline or rise are also similar in size and duration. There are many other similarities, but investors who observe the market with sharp eyes will eventually realize one truth after gaining enough experience. The truth is that the human public always responds equally to the same investment stimulus. From now on, the story of Pioneer, a virtual company famous for its legendary analogy, will be introduced with a lot of space. I think that part alone is worth buying the best investment book. As metaphors are rampant, you will understand the hidden meaning if you read them carefully. I recommend you to buy a book and read this part carefully.